Welcome back to the Deep Dive. Today we are unpacking what might be one of the most interesting earnings reports in the bio-AI space. We're talking about MindWalk, ticker HYFT.
Yeah, this one is definitely not your standard quarterly update. This company, which, used to be immunoprecise antibodies, has done a complete 180.
Total reinvention.
Totally. The whole story here is their pivot from sort of a traditional lab business to this pure play, software-driven, bio-native AI company. And that context is, well, it's everything for understanding this report from December 15th.
So our mission today for you is to really cut through the noise. We're going to break down the actual numbers, figure out what this whole bio-native AI thing actually means for them, and then pinpoint the big catalyst everyone is watching.
And that's crucial because the market got a really mixed signal here. It's what we call a dual narrative. On the one hand, you have these absolutely spectacular operational numbers.
Just incredible.
But on the other hand, there was this one little number that just poured cold water all over that initial excitement.
Okay, let's jump right into that dual narrative. Let's start with the good stuff, the headlines that looked fantastic.
All right, so record quarterly revenue from their continuing operations, $4.1 million.
Which is massive growth. I mean, up 54% year over year and up 30% just in the last quarter.
And honestly, the number that got me even more excited was the gross margin. It expanded to 65%.
65%.
Yeah.
And they were at, what, 51% a year ago?
Exactly. That's a 1,400 basis point jump. That shows real operating leverage. It proves the new model is working. And to top it off, they ended the quarter with, $16.5 million in cash. So they have runway.
Okay, but then comes the wrinkle. The number that just stopped the party cold.
Yeah. The adjusted earnings per share, it came in as a loss of 5 cents.
A 5-cent loss when the market was expecting what, a 1-cent loss?
A 1 cent loss. So a pretty big miss. And that just created immediate confusion. The stock was actually flying. It was up maybe 11% in the pre-market when those great revenue numbers hit.
Right. It looked like a total blowout.
It did. But then by the end of the day, it finished up just 4.13%. Barely moved. And that was on crazy high volume, something like 1 3/4 times the daily average.
So a ton of people were trading it, but it basically went nowhere. That tells you the market loved the story at first glance, but then they dug in.
They dug in, saw the EPS miss, and that excitement just evaporated. It means investors are saying, okay, the new model is great, but we need proof on the financing strategy, and we need it now.
Which is a perfect lead-in to the deep dive on that operational shift. Where did that 65% gross margin actually come from?
It's not just from cutting costs, which is the easy answer. The CFO is very specific about this.
Okay.
He said it came from a favorable mix of higher margin work, and that's the validation point. It proves the pivot to a software-led capital light model is actually working. They're selling more valuable stuff.
So even though they're still posting a loss overall, the quality of the business is getting healthier. Fast.
It really is. The operating loss, if you strip out things like amortization, it improved to $2.8 million from $4.1 million a year ago. Adjusted EBITDA loss, same story. They're tightening the belt while growing the top line with better margins. That is the textbook definition of leverage.
Let's talk about that $16.5 million in cash. Where did that come from? Was it organic?
That's the key question. No, that cash is a product of some pretty smart balance sheet engineering.
Okay.
About $14.3 million of it came from selling off their non-core wet lab operations in the Netherlands.
Wait, okay, so I can hear the skeptic right now asking, Are they just selling off the furniture to keep the lights on? Is this a one-time gimmick?
It's a fair question, but their answer is in what they did with the money. They argued that the lab was an anchor, part of the old capital-intensive model.
Right, it didn't fit the new AI direction.
Exactly. So they sold the past to fund the future. They immediately said the proceeds are going into R&D, into their LensAI platform, into building out the sales team, and critically, into developing their own internal assets.
And developing those assets depends entirely on their core tech, which is where things get really interesting. It's all centered on these patented things they call HYFT patterns.
Right, HYFT. The CEO spent a lot of time on this. To get it, you have to understand the problem with most biological data out there. The public databases are huge, but they're full of what's called degeneracy.
noise, basically.
Yeah.
Variations that don't really matter for function.
So much noise. So most AI models are trying to find a needle in, like a universe-sized haystack. They have to sift through all of that junk data.
Okay, I think I see where this is going.
HYFT completely flips that problem around. Think of these patterns as the absolute essential, unchangeable building blocks, the parts of a molecule that are conserved through evolution because they are critical for its job.
So instead of searching the whole haystack, their AI, LensAI, just looks for these bedrock patterns.
That's it exactly. It focuses all its computational power on what actually matters. The result is, instead of a giant list of maybes that you have to test in a lab for years, they aim to get a single best design, or a very, very short list. That's their big efficiency claim.
And they're trying to prove this out with their pipeline. The GLP-1 program is the big one, right? Going after the weight loss drug market.
A huge market. And they claim LensAI designed agonists that, in the lab, worked better than semaglutide. And they stress this wasn't just tweaking an existing drug. They used HYFT to design it from the ground up.
They also talk about a universal dengue vaccine. That's a notoriously hard problem.
Brutally hard. 4 serotypes. But again, they used HYFT to find a pattern that was conserved across all 4, something that was based purely on the biochemical evidence, not on old lists of potential targets. It's a very different approach.
And to push all this forward, they brought in new leadership, new CFO, Scott Eirikato, and a new chief business officer, Dr. Thomas Lynch. What's his job?
His mandate is crystal clear. Scale the software business. He's there to build out the software as a service, or SaaS, model, and get big pharma companies to sign enterprise deals.
Change the story from a risky biotech to a recurring revenue software company.
That's the dream. And that brings us right to the money, the capital structure play. Because if you have a great asset like a GLP-1, you need billions for trials. That usually means massive dilution for shareholders.
Which is where this segregated portfolio structure comes in.
This was the most important part of the call for investors, period. They're setting up a structure in the Cayman Islands. The idea is simple. Each asset they create, like the GLP-1, gets put into its own separate, walled-off company.
So, if I own shares in the parent company, MindWalk Holdings, why does this matter to me?
It matters because it protects you from dilution. It lets other investors, like a big venture fund, put money directly into, say, the dengue vaccine company without touching your shares in the parent company at all.
So the risk of the clinical trial is ring-fenced over there.
Exactly. And MindWalk, your company, keeps control of the core AI platform and gets upside from the asset without having to fund the whole risky journey itself.
Okay, that sounds almost too good to be true. Did they talk about the $30 million at the market offering they filed? The ATM? Because that looks a lot like a tool for dilution.
They did, and they were very direct about it. They said, yes, we registered it as a tool, a backup plan, but they were emphatic that it has not been used to date.
Emphasized in bold.
Yes, they made it very clear that asset-level financing is their primary path because it avoids that parent-level dilution. They even pointed out that a normal pharma partnership can cost you 40 or 50% of your asset right away. This structure is meant to avoid that.
So it's clear the market isn't giving them credit for this structure yet. They're in show-me mode. What is the very next catalyst we need to watch for?
Management basically drew a circle on the calendar for everyone. They said a formal update on the lead programs, and this capital strategy is coming. And the timing is key. It will be released before the market opens on the first day of the JP Morgan Healthcare Conference in early January.
So that's the deadline. That's the data point everyone is waiting for.
It is, and it makes sense in this market. Late 2025 has been brutal for any AI company, especially in biotech, that doesn't have a clear path to cash flow or a fully funded pipeline.
This whole strategy is basically their answer to that skepticism.
It's a direct, aggressive attempt to solve the single biggest risk in biotech, the capital risk.
All right. We've hit the financials, the HYFT tech, the pipeline, and this really clever capital structure. Now it's time for the part of the deep dive where we put on our speculative hat.
And we have to say, this is purely a thought experiment. This is not financial advice. We are just exploring how a very aggressive trader might look at this unique setup.
And the setup is all about volatility. The stock's up over 300% in a year, but that intraday fade after the earnings report shows you just how nervous the market is. They want proof.
So our outrageous but plausible thesis is what we'll call a long arbitrage on platform value versus asset value.
Okay, break that down.
The platform itself, LensAI and HYFT, is a high-margin patented machine that spits out valuable assets. That value belongs to the parent company, HYFT Holdings.
While the segregated portfolio structure pushes the huge financial risk of drug development onto outside investors.
Precisely. So the bet is very specific. You bet that the JPM announcement in January reveals they have signed investors for that first segregated portfolio. A done deal.
If that happens, it validates the entire capital structure and the value of their pipeline in one shot.
Yeah.
It removes the biggest question mark hanging over the stock.
So the trade itself, given all the uncertainty right now, is to go long HYFT shares. But you would also simultaneously short implied volatility right after that JPM announcement.
Whoa, okay, explain the short FIO part. That's a bit advanced.
Sure. Implied volatility is basically the fear premium baked into the options market. Right now, IV is high because the market sees huge risk. Will they find the money? Will they dilute?
A lot of uncertainty.
A ton. But if that JPM announcement confirms the financing is secured, a huge chunk of that uncertainty just vanishes instantly. When that uncertainty disappears, the fear premium, the IV, should collapse.
And that collapse in volatility would act like rocket fuel for the stock price.
Right.
Because the biggest risk has been taken off the table.
That's the theory. You're betting that the good news removes the risk premium that's currently holding the stock price down, leading to a big, sustained move up.
A bold trade for sure. We will all be watching that JPM announcement.
So, to wrap it all up, MindWalk delivered the numbers, record revenue, huge margin expansion. They proved the AI-first model works operationally. But the real story, the one to watch, is this creative financing structure designed to fund their pipeline without diluting shareholders.
So for you, listening to this, what's the big final question to chew on?
It comes down to a fundamental valuation question. The new CBO is tasked with scaling a high-margin SaaS business. So if they successfully fund their drug pipeline externally and they sign up big pharma clients to long-term software contracts, what is this company?
Is it a biotech? Or is it a software company?
Exactly. Is it a high-multiple enterprise software firm that happens to do biology? Or is it a capital-intensive drug developer with a software side hustle? The valuation multiple the market decides to apply will make all the difference.
A battle of the multiples. And the JPM conference is the opening bell. That's a fantastic place to leave it. Thank you for joining us for the deep dive.
We'll see you next time.